The country's GDP dropping by 51% in the second quarter of the year. What impact does this have on consumers, and how can we map a road to recovery? Economist Sifiso Skenjana joins us now to unpack this. Sifiso, good evening, and thank you very much for your time tonight. The largest contraction we've seen in 90 years, 4 consecutive contractions, which means we are now in deep recession. What is the economic trajectory from here?
I think if you just look at where the ailments in the economy are, right, and one of the sectors, and we've spoken extensively around this, is construction. It's now gone into its 8th consecutive quarter of negative growth. And we know that sector, of course, it's got high employment multiplier as well as employment elasticity. And so for that sector to now be in its 8th consecutive quarter of growth is a sign of the lack of investment that's taking place, particularly capital investment that's taking place in the economy. And then the other 2 sectors that, of course, that we saw having the largest contribution to the GDP number that we're seeing now is manufacturing sectors as well as the trade sectors. And if you look at specifically manufacturing, of course, that's a very big sign of a loss of productive capacity in the South African economy. And that's when you track it back from about 1995 until now, you will see that as the import intensity has been increasing, it's been towards the sectors that are labor intensive. What that means is that in a global economic context, we've become less competitive in the sectors that are more able to absorb human capital. And therefore, I think it certainly paints a very terrible picture in terms of the prospects for employment accretion in the context of South African economy.
Reading the president's statement, he seems to believe the picture would have been worse, particularly for the second quarter, had it not been for the 500 billion relief, emergency relief stimulus. Did it really play any role?
I'm not entirely convinced that it played as much of a role in terms of propping up the GDP. We do know that 60% of the GDP is a function of household expenditure. And we also saw that the July numbers coming out, I think, of BankServe shows that earnings in the economy are already somewhere between 20 and 25% down. And so some of those 350 rands, for example, would have played an important role in terms of, driving some consumption expenditure. But I think on balance, household incomes are probably much lower than they would have been pre-COVID. And therefore that the stimulus may have played a temporary role, but I don't think it certainly played a fundamental role. We also saw, of course, with the credit guarantee that only about, I think 11 billion has been taken up by businesses, and therefore that's not gone into economic activity. And again, that was supposed to be 40% of what was committed to that 500 billion, and that's not in the economy yet. And so while we can, I think, speak quite romantically around it, I'm not entirely convinced that it played that much of a role in terms of propping up the economy.
70 billion tax relief is what he's citing, but also the 40 billion that has been paid out through the UIF as one of those aspects that could have possibly put money into the economy of South Africa.
No, well, I mean, if you just look at the quality of our tax base, that's been declining over the years, right? We've seen corporate income tax, its contribution to the revenue basket declining every single year, which means is that the quality of that tax, contribution has gotten weaker. If you look at, the contribution of personal income tax, that's been increasing, but again, the breadth of the people who are actually able to even pay any tax through a personal income tax point of view is actually a very minuscule number in the context of how many people are actually in the employ of South Africa. And so all these tax relief measures are also applicable primarily to people who would have been positive taxpayers in the context of the economy. And that certainly does not make up a large portion of the 16.1 million people who were previously active participants in the labor force. And so again, yes, it makes an important, it does play a role for the people who did benefit from those tax breaks. But in the context of the South African economy, I think that number is a drop in the ocean.
Weak growth, reduced primary deficit, long-term solvency of South Africa becomes a real issue, and investors are looking at that. Are they worried?
we have to be worried because, again, we've spoken about the quality of our tax base, right? And if we're seeing that, I've often said is that we can't see the levels of concentration that are currently in existence in our South African economy if we want to see broad-based growth. If you go into any of the other economies, you start to see the role that small and medium enterprises play towards the tax basket and not just employment. In South Africa, SMEs employ 11 million people out of the 16, yet they're not able to grow to the scale that they need to grow to be much more positive contributors to the tax base. What that means then is that we're going to have a lot more fiscal pressure, and it also suggests then that our borrowing program is probably going to accelerate. And so the question is, when we do get into some form of austerity, where will it be targeted towards? Because we know that when the economy is in a contractionary environment and you embark on fiscal austerity, that often results in weaker economic growth in the medium and the long term. And so we've got to be really smart in figuring out which plugs to close in terms of cutting some of our budget to ensure that we can prop up the economy from a fiscal and a solvency point of view.
So you're saying there is no way we can see better growth and borrow less. We have got to somehow manage borrowing more and still be seeing the kind of growth that we want to see.
Yeah, so there's good and bad borrowing, and we've also got to understand the cyclicality of what we are trying to borrow. And so if we know that us borrowing in the short and medium term will result in a U curve or J curve recovery, and then that's a counter-cyclical impact towards from a budget point of view, as well as then what you expect from a growth. And so it's understanding that certain sectors will require us to be to extend our borrowing program to drive growth in those sectors. But as I said, is that there is good borrowing and there is bad borrowing, and when we are borrowing to continue to prop up SOEs, that's certainly not the kind of borrowing that we need to see in the context of our economy. When we are borrowing to prop up municipalities who have not become financially viable, that is very bad borrowing in the context of the South African economy. But when we are driving social spending that is geared towards human capital development, that is good borrowing. When we are borrowing towards infrastructure investment and or secondary sector development, those are good borrowing programs. It's really around ensuring that we target our borrowing programs towards the right channels.
Do rating agencies draw that distinction, or the borrowing is likely going to trigger further downgrades?
I think they consider the structure of the economy more than anything, and they view in terms of what are the levers that are currently available for the economy to grow. And when those levers are unavailable, and then it becomes evident that the only way to fund growth is through borrowing. And then it's understanding that, do we have the right multipliers in our economy to be able to get back onto a growth path in a medium-term context? If not, then that suggests that, of course, that we get into a broken debt spiral. And so those are some of the things that they are putting into their models. I think there's also other market structure context when you look at, for example, the level of systemic risk in our financial system, how capitalized our banks, because you can have an economic crisis that can quite easily lead to a financial crisis, and that becomes a lot more dangerous for the sustainability of an economy. And so a lot of those metrics also go into their modeling, and that would primarily then inform the next ratings decisions.
Now, President, talking about three things that need to be done, once again calling for a social compact for the economic recovery post COVID-19, which will be established at NEDLEC. We are back again at talking about structural reforms. We've been talking about them, I don't know for how long, and whether or not they will be taken seriously right now. He's pointing out, of course, investment in infrastructure. And he's talking about something, I don't know if you know much about it, it's called the Presidential Employment Stimulus. What do you know about that?
I suspect that's some of the programs that are going to come out of the Jobs Fund, but I don't know too much information around that. What I can speak to, again, is that this idea of structural reforms are again, the words that are sitting somewhere in the clouds, because they're not telling us how those things come alive. And so when you say structural reform and you say we want to rationalize our borrowing and want to stabilize our debt, there's got to be a doing item and an action towards that. And so there are many things that can inform structural reform. Investing in your human capital is a structural reform, for example. So I'm not convinced with the kind of narrative that we're hearing around, we need to go towards structural reform, that there's real commitment towards it until it gets a name. It says this is exactly the thing that we will reform. Besides a bloated, public wage bill, there's no other structural reform that we're hearing, and we know that they're going to struggle with that, particularly now leading to local elections. And when you also take a step back and say, how did it even get bloated? It was a recovery mechanism following the 2009 financial crisis that was driven primarily through the EPWP program. And so a lot of these things that are informing why there are some structural issues, as well as then one of which is the bloated public wage bill, are contextual, and the way out of it is going to be the more interesting conversation.